Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today on 94.1 FM WNBU or Cable TV 10 in New Bern, North Carolina. Also, many of you may be streaming this from the internet from our website, www.dlblain.com. We encourage you to let us know what you think of the show, comments, questions. If you'd like to have a topic that you'd like to appear on the show, visit us on the web, www.dlblain.com. Of course, our email is allthingsmoney@dlblain.com, and you can also give us a call at 252-633-0107. Well, we had great first two segments today. We were talking about some President Obama's job plan, as well as Warren Buffett's assertion that the rich are taxed less than secretaries. So if you missed that, we'll have archives up on the website here in about a week or so. I wanted to move in the time we have left here today, and we'll try to continue this. Now is the time of the year, at least in our firm, where we really start gearing up for some year-end tax planning. Tax planning is a significant part of what we do for our clients. You know, as a wealth management firm, that term has been sort of corrupted, and in fact, some of the industry jargon, most advisors are more interested in gathering assets, and the wealth management is simply a moniker. Well, at our firm, we truly believe in it, and a big part of wealth management is tax planning, tax management, as well as, of course, the tax compliance portion, which is filling out the forms in April. In fact, I think I mentioned this a couple weeks ago, but we recently hired from Chicago Tom Adams, who's a CPA out of Chicago, joined our firm the 1st of September, and so we're excited to have Tom on staff. We also have enrolled agents and a lot of tax expertise in the firm. So anyway, about this time of year, we start gearing up for some good year-end tax planning. You know, sitting down with a CPA or your tax planner or TurboTax or whatever in April, it's a little late to do tax planning. So you want to start thinking about it now. So I just thought I would run through a couple of things. That the past several years have just been all kinds of changes to the tax code and new things coming into the tax code, some things expiring this year, other things that year. Things, you know, it's just, there have been a flurry of tax bills as from starting with President Bush and President Obama and Congress as they try to stimulate the economy and tinker with the tax code, and it's a real mess. That's a topic for another day. So we want to talk about a few things today. Number one is the AMT, the Alternative Minimum Tax. If you're not familiar with it, the Alternative Minimum Tax is a tax that is designed to ensure that everyone pays a minimum amount of tax, even if they have enough exemptions. And so we see that each person has a $74,000. For married filing jointly, it's about $75,000 exemption. Single people have about a $48,000 exemption. And so if you're under that amount, you don't have to worry about the AMT. But if you are, boy, can it be very nasty little tax if you're subject to it. So we want to look at, it limits some deductions and doesn't permit others. Things like state and local income tax, property tax deductions, miscellaneous deductions. And so the AMT is much too complicated to get into on the radio and TV, but what I want people to do is be aware of it. And if you think you're subject to AMT or you were in the past, really you need to start planning for it now to avoid it. So let's talk about a few things that are applicable to everyone. Property tax deduction. If you own a home or rental property, those taxes are tax deductible. And so if you need extra tax deductions, you may consider prepaying your tax. Most property tax here in Craven County, they send out the bills September the 1st, but you can wait until, I think it's the 5th of January to pay before you're being late. Well, if you need the deductions, you certainly want to, pay them ahead of time. Sometimes people will even bunch deductions. So let's say you're going to have higher income in 2012, well, you may want to wait until January 1st, 2012, pay that property tax, and then at the end of 2012, pay another property tax. So you've got two property tax bills in the same year. That can be a good strategy. Mortgage interest. Generally, interest up to $1 million of mortgage debt is tax deductible on your primary or secondary residence. Any points you paid related to your principal residence are also deductible. So sometimes when you take out a mortgage and you pay what's called points or extra fees to get a lower interest rate, those points are deductible. So if you recently bought a home and you paid points, you want to look at your HUD-1, your closing statement, to look for any deductible points. Home equity debt is also deductible. Interest on home equity, it has to be used to improve your principal residence. Now, I know people go out there and they buy cars and finance their kids' tuition and everything else on their home equity. Just know, you know, be aware what the tax code actually says, and that limit is interest used for any purchase. The debt limit of up to $100,000 may be deductible. So beware though of the AMT, which we spoke about earlier. Home sale, if you sell your home for your principal residence, you can exclude up to $250,000 or $500,000 for joint filers. So this is a rule that we run into some older taxpayers that still don't know about this rule. I guess years ago, and this was before I really was involved in tax planning, you had to pay tax if you sold your home. Well, today, if you're married, you get a $500,000 exemption. There are some non-qualified uses for the home that will eliminate that, as well as any losses on the sale of your home are not deductible. If you rent your home or use your business as a home, there's a whole different set of rules that apply. We may get into next time. We're running out of time for today. The last thing I want to mention is that if your home, if you receive some sort of debt forgiveness, you know, you're foreclosed on or did a short sale, that you generally don't have to pay federal income tax on that debt forgiveness. That did not used to be the case, but one of the myriad of new rules they passed generally excludes that from income. Well, that's about all the time we have for today's show. We'll pick up on some more year-end tax planning tips next week. So we hope you enjoyed the show, and we look forward to seeing you again next week. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.